All right. Hey there, everyone. Happy Friday. My name is Dan. I'm the Customer Learning and Development Consultant here at RightCapital. I'm thrilled to be here with you today. And as always, I appreciate everyone taking the time out of your Friday to join me here for this presentation. Today, we're going to be talking about modeling properties in RightCapital. So we've been getting a lot of feedback over the last couple months related to properties. So I'm excited to be able to walk through this with all of you here today. We are going to be covering quite a lot of ground here. So let's take a quick look over our agenda before we dive into RightCapital for today. We will be touching on data entry for both properties and mortgages to start things off today. So we're going to enter one of each type of property, those being the primary home, a vacation property, and also an investment property or rental, as well as a mortgage. While we're doing that, we're also going to touch on some of the tax implications, especially some of the opportunities around rental properties. So we'll dive into some of that as well. We'll then touch a little bit on modeling some common scenarios, things like a refinance, a 1031 exchange, comparing alternative scenarios when it comes to purchasing and selling properties at different points in time. So we'll be spending a little bit of time in the retirement analysis as well, setting up some of those what if scenarios and comparisons. So a lot of ground we're going to be covering here today, like I said. So I don't want to waste too much time here, but I do, of course, want to mention to everyone, especially for those of you that might be newer to RightCapital, that firstly, these webinars are recorded, and we will be posting a recording of this webinar in our Help Center. So I'll be sure to show you all where you can find that towards the end of the presentation today. And I also want to mention that these webinars are also interactive. So I have about 40 to 45 minutes of content prepared for you today, and then I will be sticking around until the top of the hour to answer your questions. You should find a Q&A field in the Zoom control panel on your screen. Feel free to ask any questions you have as we're making our way through the presentation today. I'll be here to help however I can. All right, without further ado here, let's dive into the presentation for today. Here we are in the case study for Frank and Barbara. And we're going to dive right into some data entry here. So we're going to start things off by clicking into the profile area and specifically the net worth section here. This is where properties are entered in RightCapital. I do want to quickly note, if you're within the initial data entry process for a client, by default, this is the fourth step of that initial process. It will be labeled net worth and it will look exactly like this. So you can enter properties during that initial process as well as down the road at any point in the profile. So we are going to start today by walking through the primary home, which is already pre-populated within the property area here. And then, as I mentioned, we're going to touch on adding some additional property types as well. So let's start with the primary home. This will help us get a little bit more comfortable in general with the data entry process when it comes to properties in RightCapital. First and foremost, for those clients that might be renting rather than homeowners, you can simply leave this set to rent. It's going to greatly simplify things for you here. You can enter the client's current monthly rent, as well as any annual renter's insurance that they pay. So very straightforward for those clients who are renters. Of course, more likely than not for those clients who are homeowners. You will want to swap from rent to own, and then you'll be able to enter the details for that property. So we're going to walk through each field here. Of course, you can change the name if you'd like of that property, and that will flow into the cash flows. You'll be able to see that reflected. You'll want to make sure to select the correct owner here, whether that's the client, co-client, or maybe jointly owned. You'll also want to enter the purchase year. I do want to mention that this is more of a categorical input. If you're not exactly sure when the client purchased this property, you can leave it to already started, assuming it was purchased at some point in the past. But if you happen to know, you can enter that purchase year here as well, and that will be tracked within the plan. The purchase price is an important input not to overlook here. This one does impact the future looking projections within the plan. If you ever choose to sell this property, this value will be referenced when it comes to capital gains taxes. So definitely an important input here with the purchase price. Of course, we'll want to specify the current value of this property, which hopefully is higher than the purchase price at that point in time. You can also choose, if you'd like, to enter an annual appreciation percentage. this will be applied both to of course, the property value itself, as well as the annual insurance costs that you enter. So if you want to see those appreciate at a certain rate throughout the projections, you can specify that here. And then the last couple fields within the primary home are for some property related fees, specifically property taxes, insurance and HOA, and then annual maintenance fees. So let's dial in some parameters here, just some rough numbers. I do want to mention when it comes to these fields, a common question that we tend to get is, why are we entering these expenses here? Why aren't we baking these property related fees into the client's living expenses, which are entered into, of course, the expenses or goals areas within these living expense cards here. So that's a common question we tend to get. And the reason why we want to enter those expenses separately within that property entry itself in the net worth is so that if we ever decide to sell that property at any point in the projections, the system will know to change or to stop these fees associated with that property. So if we, in this case, were to model something down the road, like a primary home relocation where we sell this property and purchase a new property, the system will then know, all the fees associated with this property will stop at that point in time, and whatever fees are associated with the new property will start. So it can be valuable to have those entered separately from the living expenses here in the property itself. And we'll also be able to track these separately within the cash flows as well, which we'll take a look at in just a bit here. So before moving on from the primary home, last thing I'll mention here is that while the primary home can't be deleted from the plan, you'll notice that this is a permanent entry within each household in RightCapital. If you are ever in a situation where you need to essentially eliminate the primary home from the plan, maybe you have a younger client who's living with their parents, or maybe vice versa, older clients who are living with their children, in those cases, you can swap from own back to rent and simply enter $0 for the rent and insurance. That's essentially going to eliminate the primary home from the retirement projections entirely. So I always like to mention that although it can't be deleted per se, you can always turn this off within the projections. All right, so that covers it for the primary home here, and that's a good starting point when it comes to modeling properties in RightCapital. There's going to be a lot of overlap here between what we just walked through for the primary home and what we're about to walk through for some of these other property types. So let's quickly add a vacation home here by clicking Add Account, hovering over Property, and then adding a vacation home. Like I mentioned, most of the data entry here will be the same as what we just walked through for the primary home, but you will find a couple additional fields here for the location as well as the year of sale. So something I do want to point out before we enter some numbers here. The location for the primary home, you may have noticed, is not entered within the primary home entry here in the net worth. The reason for that is during the initial data entry process, when you enter the members of that client household into the family area, the resident state is actually entered into that first client card in this step of the data entry. And this is what will be used as the primary state of residence for the clients, for their primary home. So something to keep in mind there, this will be used, whatever state you enter here is going to be used for state tax calculations in RightCapital, and this will also be assumed to be where their primary residence is located. So that's the first thing I want to mention there. Of course, for those additional properties, vacation and investment, you will want to specify the location of that property as well. So let's actually select something other than Connecticut for this property. Let's say maybe these clients own a vacation home in Florida. Maybe this is a condo. So let's call this Florida condo. We will again enter some of these same inputs here, the purchase price, the current value. So let's enter some rough numbers there. Again, the purchase price is going to be an important input that you'll want to remember to enter, especially if the clients are thinking about maybe selling this property at some point down the road. Again, that'll be used for capital gains calculations in the year of sale, so definitely an important one to enter here. Once again, we'll enter that tax information, insurance, HOA, and maintenance fees. So again, let's enter some rough numbers here for these. Something I do want to mention, insurance and HOA both get lumped into this annual insurance field. When we take a look at the cash flows in just a bit, you'll actually see this column in the cash flows labeled as insurance and HOA together. So something to keep in mind there. We already entered the location here. The last input I want to highlight when it comes to vacation homes is the year of sale. So, if the clients are thinking of selling this property at any point, we can indicate that here. And this is what will be reflected in the client's current plan. So, end of both plans is essentially a way of saying, this property will never be sold in the retirement projections. It's going to be retained until the end of the plan. But if they do plan to sell that earlier, you can choose a calendar year, a specific client's age, or a specific client's year of retirement. So that can be valuable as well. You do, of course, have the flexibility to propose different years of sale in the retirement section and sort of compare and contrast different scenarios there. So we'll certainly take a look at that kind of comparison in just a couple minutes here. Before we do that, though, I do want to touch on rental properties as well. So let's add an investment property here by clicking Add Account. Again, hover over Property and then adding an investment property. Again, there will be some overlap here. So let's go ahead and enter some of these inputs: purchase price, current value, and then, of course, those property-related fees would be entered here as well. Of course, when it comes to rental properties, there are a couple differences that are important to keep in mind. So I do want to scroll down a little bit here and walk through the rest of the fields here that are a little bit more unique to investment properties in RightCapital. So first and foremost, these first four fields are for rental income. How much are these clients expecting to receive each year in rent within the projections from this property? And this is an example of one of those cases where RightCapital actually gives you two different options to enter this information. You'll find in general in RightCapital, we will often give you a quick and easy option as well as a more detailed option when it comes to entering client data. So depending on the use case, depending on how quickly you need to enter that client's data, or maybe depending on how much information the client is able to give you at a certain point in time, you do have some flexibility here. So the simple growth rent approach is going to be the quicker and easier of the two options here. This is going to be a sort of linear projection when it comes to rent. So we can, of course, enter the monthly rent, just a ballpark number that the clients are currently receiving or expecting to receive. We can dial in, like I said, a linear rental increase, which will, of course, be applied to that rental income amount each year. And then, if the clients are expecting that property to be vacant for a certain percentage of the year, we can indicate that percentage here, and that will offset the income, based on whatever's entered. So when it comes to the simple growth approach, pretty quick and easy to enter here to dial in some ballpark numbers. Of course, for those clients where maybe we do need to get a little bit more detailed, we do have the option to use a detailed schedule. And what this will do is essentially allow us to manipulate line by line, year by year, the monthly rental income and the yearly vacancy rates for each and every year throughout the entire duration of the projections. So this can be helpful if maybe the clients are planning to take this property off the market for a few years, if they're expecting maybe some fluctuations in the rental income, if that's going to increase or decrease more substantially at a certain point in time, you're able to reflect all of that here. So this can certainly be useful in those use cases. You may notice something I did here is if you start by entering the simple growth values and then switch over to the detailed schedule, it will actually pre-fill the detailed schedule with the simple growth values. So this can be helpful if you want to maybe use those simple linear projections as a starting point. So of course that 2,500 plus that 3% increase I entered, and then that 5% vacancy rate. And then you can make further adjustments, on a year by year basis, depending on what you need to see. So that's certainly, a great starting point if you want to use that simple growth approach. There are, of course, other quick fill options here to make your life easier. If you need to start fresh, you can clear all the values, reset everything to zero. If you want to fill the gaps between two sets of values, that's where interpolate comes in handy. So again, maybe we want to use that 5% vacancy rate every year. We can enter that for the first and last year, click interpolate, and it's going to fill in all the gaps for us. So that can be helpful. So you don't have to type, a certain value into every line. And of course, if you want to bring back that simple growth projection to use as the starting point, you have a quick and easy option to do that as well. So hopefully these quick fill options will save you some time during this step of the data entry if you find yourself using the detailed rental schedule. All right, so we are going to stick with the simple growth approach here just for the sake of time today. I do want to walk through, however, the last couple of fields within this card just to touch on some of the more nuanced tax opportunities, tax details related to investment properties. So first things first, when it comes to these last couple of fields, you'll notice that a field unique to the investment property entry is the total tax basis. And this is, of course, representing the total cost basis of the property, excluding land. So that's the main thing to remember here. We want to make sure not to include any non-depreciable portion of that value. And the main thing I want to highlight here actually is that when it comes to these investment properties, the total tax basis actually replaces the purchase price in terms of the value RightCapital is going to reference when this property is sold. So I mentioned when it comes to the primary home and vacation properties, we use the purchase price when it comes to calculating capital gains on, the sale of a property. However, for investment properties, it actually looks to the total tax basis instead. So, you can always enter the same value for each if, that's, what you want to do there, but do know that the purchase price for investment properties is more categorical. The total tax basis is the one you'll want to make sure to enter here. Leaving this at $0 can result in some strange looking output. It can definitely, inflate your taxes in those years. So, we can actually take a look at a scenario like that. That is a relatively common question that our support team tends to get. So maybe we'll set up a comparison like that in just a few minutes here so you can all see what that looks like if this is left blank. But for now, I do want to touch on the rest of these fields here. So moving on, the next two fields within this entry are for depreciation. This is where we can enter the accumulated and annual depreciation. We aren't going to be diving too deep into the nuances of this particular element in today's presentation, but considering this is one of the major tax benefits for landlords and real estate investors, it's definitely important to be aware that this is here. And luckily, RightCapital will do most of the work for you here in terms of the tax impact once we enter these values. So for those of you who maybe are unfamiliar, depreciation on rental properties is a tax benefit that allows you to deduct the value of the rental property from your taxable income, spread out over a period of time. And for our purposes here today, within the system, that period of time is 27 and a half years. RightCapital treats investment properties as residential rental properties with a useful life of 27 and a half years. So something to keep in mind for those clients who are landlords. And this deduction will occur either until the total tax basis of the property has been reached or until we've reached that maximum time frame of 27 and a half years. So when it comes to entering this into RightCapital, the accumulated depreciation is going to be the total depreciation that's already accumulated as of today. And that's essentially going to reduce our total tax basis when it comes to the maximum deduction amount we can claim. And the annual depreciation amount is what we're actually deducting each year going forward. And this is going to flow into the tax calculations in RightCapital. If we were to take a look at the sample tax forms in the tax module, you would actually see this offsetting the rental income on the Schedule 1. So we will be taking a look at those tax forms in a moment here. But in terms of what to actually enter, this tends to be a question our support team gets on a regular basis. So while there are different methods and strategies that some advisors will utilize, most often what we tend to see advisors do is a simple depreciation calculation, which is, just taking the total tax basis of the property, dividing it by that 27 and a half years, and spreading out the deduction evenly over that time frame. So I did do the math in advance here with that total tax basis of 800K. That would give us, for this property, 29,091. So plug that value in there. And let's say maybe we've already accumulated that amount for 3 years. So I'll enter 87,273 for our accumulated depreciation value. Great. So that brings us to our last field here, which is for passive loss carryover. This is going to be, applicable in cases where maybe the clients have been losing money for a period of time on this rental. And when it comes to these deductions in RightCapital, all of the passive activity rules are built into the system. So again, RightCapital will do most of the work for you here. Clients will be able to deduct up to 25K per year in passive losses as long as they are below that MAGI phase out. And this particular field here is where we can enter any losses that were not able to be deducted in previous years that were carried forward to the present day. So, if this rental were to become profitable in the future, we'll see that deduction begin to occur within the plan. And again, that would offset the rental income that flows through into the client's Schedule 1. In cases where maybe the property taxes, insurance, and maintenance fees are maybe going to outweigh the rental income that we enter here, do note that any future passive losses that aren't able to be deducted will automatically continue to carry forward until the property is sold, which, coincidentally is our last input here. So, we can choose when we want to see this property sold during the projections, whether that's, a specific year, when one client or the other retires, and so on. All right. So the last thing I'll mention here in regards to some of these tax impacts is that, when these properties are sold, RightCapital will also automatically calculate and perform what's called a depreciation recapture. So if the sale price of the property exceeds the adjusted tax basis at the time of the sale, the difference between those values will get taxed at ordinary income rates rather than, long-term capital gains rates, up to a max of 25%. So for these 27 and a half year properties, this is actually called the unrecaptured Section 1250 gain. I know, a little technical, but this is also something we'll be able to see in the sample tax forms, specifically on the Schedule D. So I wanted to mention that as well. So I know that was a lot of information. Just to put a cap on everything we just touched on, I do want to quickly highlight those sample tax forms just because we have mentioned them multiple times now. So for those of you that might be newer to RightCapital, you can find the sample tax forms within each client plan within the tax tab here, specifically within the tax estimate area by clicking into the details tab here. So all of these forms pre-populate with information based on all of your data entry. And you can view these for every single year of the future-looking projections. So, while these are, of course, estimates based on data entry and assumptions, we do get some very valuable information here in terms of, how RightCapital is calculating the federal tax figures for a client for each year. When it comes to rental properties in particular, you will be able to find the rental income on the Schedule 1 here. So that would reflect on line 5. And then we would also be able to see on the Schedule D, like I mentioned, the capital gains from the sale, I believe on line 11. So yes, lines 11 through 15 would be that long-term capital gains. And I believe the depreciation recapture would also be visible here on line 19. So, all of those details will flow into the tax forms here within the plan, once you've filled out those values. All right. So that does cover it for investment properties. That is certainly the most in the weeds that we'll be getting today in terms of some of these tax complexities. But I do always like to highlight those details so that we can all be confident that these variables are being captured and ultimately reflected in the output that we see in the plan. All right, moving on here. The next thing I want to touch on is data entry for mortgages. So I'm going to pivot back into the profile net worth section here. To add a mortgage for a property, we would click Add Account in the upper right and then select Loan. You do have the flexibility to choose some different types of mortgages, adjustable rate mortgages, interest-only mortgages. For today, we are just going to be walking through a more traditional mortgage entry here. This is another example of a situation where, depending on the time and information available to you, you do sort of have two options here when it comes to entering this information. If you're working with a prospect or a new client, do know that you can simply enter the current balance and the monthly payment amount, and that will be sufficient to calculate a payment schedule within the plan. So if you don't have all the details for this client's mortgage, do know that that is an option for you. If you were to simply fill out these two fields and click save, we would still see this mortgage be paid down within the plan. So I always like to mention that can definitely be helpful if you are working with prospects in particular. However, if you do have the rest of this information, we are able to get a little bit more detailed here. So we'll want to enter the original amount of that mortgage, the interest rate on that mortgage, and then the loan term at the top here. These three inputs in particular will be used to automatically calculate a minimum payment here. So if I click save and then reopen that mortgage, we'll actually be able to see based on those three values what the minimum payment is. So if clients are making the minimum payment each month, you can simply copy and paste that value into the monthly payment field. If clients are making more than the minimum payment, do know that if you enter a higher dollar value here, that will be reflected in the plan rather than the minimum, and vice versa. If you enter a lower value here, RightCapital will use the higher of. So regardless, whichever value is higher is the one that will be used within the plan. So something to keep in mind there as well. Last thing I'll mention, the origination year is more of a categorical input here. Doesn't actually impact the calculations in any way, but if you do want to list that just to have that stored within the plan, you can always enter that origination year as well. The last piece of the puzzle here when it comes to entering mortgages is to link the mortgage to a specific property. So especially for clients that do have multiple properties, this is definitely an important step, especially if we're going to be modeling different scenarios when it comes to relocating or selling some of these properties. Linking the mortgage to that property is going to, help accurately capture that in the projections. So that's definitely an important piece of the puzzle here when it comes to mortgages. If we were to sell a property with an outstanding mortgage balance, it will automatically pay off that remaining balance, and that will offset the proceeds from the sale. So you'll be able to see that within the cash flow projections as well. Speaking of the cash flows, now that we've entered one of each property type as well as a mortgage into the net worth section of the profile here, I do want to quickly pivot into the cash flows just to show everyone where all of this information can be found and tracked going forward. So in particular, in the retirement cash flows summary tab, this is where we're going to be able to find some of the expense information related to those properties as well as any income. So first and foremost, if we click into cash inflows, we would see any rental income from that property occurring here in the other inflows column. Looks like I may have set the year of sale for this rental to 2026. So we can see that sale happening in this column here as well. But do know if this rental were being sold later on in the plan, we would see that rental income continue until that property is sold. If we were looking for some of the expenses related to these properties, we can click into the expenses column here, and then again into the housing column. This is where we can find all of the um, costs related to the primary home. So in this case, that's going to be that mortgage P&I that I entered for that mortgage linked to the primary home, and also the property tax, insurance, and maintenance fees for the primary home as well. If you'll remember, I did note that we lump together insurance and HOA in RightCapital. So, you can include HOA fees in with the annual insurance when you're entering that into the property. There is a separate column here in the expenses area for rental and vacation homes. So, I entered some expenses for that Florida condo, that vacation home as well, and we can track those separately within this area, the rental and vacation area. So all that information is sort of broken out in a very detailed way here in the cash flows. So this can be helpful to track all of that. I do want to also mention that in the cash flows net worth area, this is where we can actually track some of the balances, both, the property values themselves as well as the mortgages. So you may notice right off the bat here, we have separate columns when it comes to primary and vacation homes and investment properties. So again, I set the year of sale there to 2026, but we can see in year one, we have that value for our rental property. And then we can track the value of the primary home and that Florida condo over time in the primary and vacation home column. If you were looking to track the mortgage balance as that's being paid down, there's a separate column for mortgages as well. So we can track that as it's being paid off and identify the year that's fully paid down in this column here. All right, to wrap up the data entry portion of today's presentation, I do just want to quickly highlight the fact that property goals can be entered into the profile goals area of a client's plan as well. So everything we've done so far today, everything we've entered in the profile net worth area here, this is going to be for properties that the clients already own, for existing properties that we want to reflect within the client's current plan. However, for those clients who do have the goal of purchasing a property down the road or potentially relocating, maybe moving down south is a common example, all of that can be modeled here in the profile goals area. So if we click add goal in the upper right and then hover over property, we'll actually see some of the same options that we saw back in the net worth. And if we were to click something like a vacation home goal here, you'll notice that when it comes to the data entry, it's pretty much identical to what we already walked through in the net worth. So I'm not going to spend too much time walking through the data entry again for something like a vacation home purchase goal. The one thing I do want to highlight though is that the one difference is that you will also want to enter some of the information related to the down payment and the mortgage. So when it comes to property purchases, do know that you don't have to enter the mortgage separately. You'll be able to enter all that information right here within the goal card. So this is sort of a two-in-one. It allows you to both to reflect the purchase price, the year, and some of those other costs related to the new property purchase. And then you can also enter, are we paying for that up front, putting 100% down, or are we going to be maybe putting something like 20% down, taking out a mortgage at a certain interest rate for a certain period of time. So do note that all that information is entered within the same card here when it comes to these property purchase goals. I do want to highlight some of the other differences for investment property purchases as well. So if we click add goal and then add an investment property purchase, I do want to highlight quickly, there is a couple different options here when it comes to the acquisition type. So rather than simply purchasing a property upfront, you can also model the client inheriting a property or converting an existing property into a rental. So if we wanted to maybe model a situation where the clients maybe want to turn that Florida condo, which is, currently a vacation home, into a rental property at some point down the road and, maybe start receiving some income off of that, do know that that's something you can model here by, manipulating the acquisition type. So you have a lot of flexibility to really model lots of different scenarios depending on your client situation and what their goals are. Last but not least, I do want to quickly just take a look at the primary home relocation card. This is one of the more common goals in general that we see advisors enter into financial plans. And again, this is one of those two-in-one cards where we're not only specifying the details of the new primary home, again, whether we're purchasing that, inheriting that, maybe moving into an existing property, we're also going to be specifying what's happening to their existing primary home. So, are they planning to sell their current primary when they move into this new home? Or are they going to hold on to their existing primary home and maybe convert that into a vacation home or even a rental property? So again, lots of options here depending on what you need to model for a given client. One thing I do want to just call out quickly, if you'll remember, there is no year of sale field in the primary home entry within the net worth area. So if you do want to model a client selling their primary home, it does need to be done with a primary home relocation card here. And if you're finding yourself in a situation where maybe you need to model the sale of that existing primary home without necessarily purchasing a new property, you can use that same logic from before when I mentioned, turning off the primary home and the net worth. You can select rent a home for the new home option, leave the rent at zero, and then whenever you want them to sell that current primary home, or rather the existing primary home, you can enter that here. So that's always an option for you as well. I find that sometimes this is useful if you have clients that are, a bit older and maybe they're going to be entering a nursing home facility or entering some form of long-term care and selling their primary home at that same time, but not necessarily purchasing a new property. This can be helpful for that. All right, so I want to make sure to save time here to touch on some common scenarios in the retirement section, as well as, of course, the Q&A for today. But I do also want to quickly just touch on the fact that there are a handful of settings and assumptions that are important to just keep in the back of your mind when it comes to specifically purchasing and selling real estate within a plan. So I do want to call this out quickly. In the gear icon settings tab, if you click into the other assumptions page here, you will find two settings that will specifically impact the cost of purchasing as well as the cost of selling property within the projections. And again, this is a common question that our support team tends to get from advisors. If you're modeling, a property sale, for instance, and you notice that the proceeds are a little bit lower than you were expecting, do note that there is a 6% cost of sale, entered it by default in RightCapital. And similarly, there's a small cost of purchasing just to represent typical closing costs when it comes to purchasing real estate as well. So if the numbers and the cash flows maybe are a little bit off compared to what you were expecting to see based on the values you entered, do double check the gear icon, settings, other assumptions tab. It's likely that, it's one of these two assumptions impacting that value. And of course, you can change these on a per client basis by, switching to customized, entering a new value. I do sometimes see advisors eliminate these, or of course, you can change it to whatever value you'd like to see in your client plans. So you always have full control over these assumptions. All right, so I did want to quickly mention that just because it is important, but the next thing we're going to be doing here is diving into the retirement analysis, talking about some common what if scenarios, modeling some common proposals, and also setting up some comparisons. So first things first, just taking a step back, the retirement analysis is, of course, where we're able to model those what if scenarios in RightCapital, highlight the value of specific recommendations, as well as directly compare two different scenarios against one another. So, the possibilities are nearly endless here when it comes to mixing and matching different inputs. But for our purposes today, let's review some common examples as it relates to properties. First thing I want to mention is that all of those same property goals that we touched on in the profile area, primary home relocations, vacation and rental property purchase goals, all of those can be modeled in the profile as a part of a client's current plan. But if you're finding yourself wanting to propose those items so that they only impact the proposed plan and not the current, do know that you can add all of those same inputs here in the action items. The way that we can do that is by clicking the edit button in the lower right, clicking add new items at the bottom here, and then hovering over goals. You'll find all the same property goals for primary home relocations, investment and vacation property purchases. So if you have clients that maybe aren't planning to do that as of today, but are maybe wondering, is that something we can afford to do down the road? How is that going to impact our bigger picture? This can be a really valuable way to set up a comparison. So let's go ahead and do that actually. Let's set up a simple comparison here where maybe our clients are asking, we'd like to purchase, a vacation home down south, but we're not sure if we can afford to do so. We can add that vacation home purchase. We can add the purchase price here, specify all the same details that we talked about in terms of, the location, the year, etc. So again, I won't spend too much time here repeating this process, but ultimately, once we have this entered, that's going to be factored into the proposed plan and not the current. So we can then say, here's where you're at today if you don't purchase that vacation home, and here's where you might be if you do. And in this case, we can see while the probability of success hasn't changed, we do see a pretty major difference here in terms of ending assets. So, depending on the client's goals and what they're okay with, this can be a valuable way to sort of set up those comparisons and figure out if that's something that we want to aim for or not. So that's just a simple example. I do want to call out specifically that when you add purchase goals for investment properties here, a common question is if you can model 1031 exchanges in RightCapital. You, of course, are able to do so. We make it pretty easy to model that kind of scenario. So if we add a new investment property purchase here, you will notice that in the data entry, if you scroll down to the bottom, there is a dedicated field here for a 1031 exchange, and you can select any of the other rentals within the plan here to exchange there. So this is sometimes called a like kind exchange. It's another tax break that lets you defer the capital gains taxes that would normally be realized upon selling one of these rentals. So do know that you can model these in RightCapital, and it's relatively easy to do so using this 1031 exchange field here. Another common scenario that our support team tends to be asked about is how to model a refinance. And that's something, again, that we're able to propose here within the action items. So the way that we would model something like a refinance is, again, to click the edit button in the lower right, click add new items at the bottom. This time we are going to hover over income rather than goals. And in particular, we're going to add a new loan card to this proposed plan. So what these cards allow us to do is not only enter the details of a new loan, again, very similar to what we see in the profile net worth when entering existing loans. You'll also find a dedicated field for a refinance, and you'll be able to select the existing mortgages in your plan here. So this is essentially a cash out refi. So, you can add a loan amount here. If it's higher than the outstanding balance on the existing mortgage, the difference between the two will be reflected in the plan as an income stream. So you're able to easily model that kind of scenario within a proposal here as well. And of course, just like I mentioned with the goals, you can model those as part of a proposal, or you can always add those to the current plan as well within the profile income area. So for everything we're touching on here, you always have the ability to add it to the current plan in the profile or to the proposed plan here in the retirement section. All right. The last thing I want to touch on here is just the fact that we can also set up some different scenarios to more directly compare and contrast maybe purchasing or selling properties at different times. So first and foremost, you may have already noticed, but in the lower right corner of the action items here, you will see all of the properties in the plan listed along with their years of sale. And if you do want to very quickly model a different year of sale for a property and see the impact, do know that you can very quickly and easily do so here. So if we wanted to, sell Frank's vacation home at a different point in time, we can, dial in a different year here, click refresh in the lower right, and again, that change will impact the proposed plan compared to the current. We can see the impact there. So you can always change those years of sale, and when you do make a change like that, it will be highlighted in blue here so you can easily identify the differences between the current and the proposed. All right, so I'm going to turn some of these items off here just to clean things up a little bit. We are going to set up a more specific comparison here. So let me turn off some of these additional items that I've added here. Another common example, and the last example we're going to review today before diving into the Q&A is maybe purchasing new properties within a proposal here, but taking a look at maybe putting down different amounts for each situation. So, a common example of that might be one scenario where we're purchasing a property and just paying for that outright, 100% down, versus a separate scenario where we're purchasing the same property, but instead putting maybe 20% down with a certain term and interest rate. And then, there'll be a mortgage reflected in that scenario. So again, that's something that we can model here by adding property purchase goals. So let's maybe repurpose rather one of the ones that we've already added just for the sake of time here. So first and foremost, we can add our property goal here for something like a vacation home purchase. Let's add a purchase price here, the location, and the year of that purchase. Again, if you'll remember, you can reflect the down payment here as well as the term and interest rate. So for this first card, we'll say that this will be the one where the clients are putting 100% down. So we'll leave the down payment set to 100%. We will also likely want to name this something that will be a little bit more easily recognizable. This can be a helpful tip for you when working with proposals like this, just to more easily identify in the action items, what item is which without having to click into these items. So let's say 100% down here is the name for this goal, and then click Save. So with that, we now have our 100% down item here. We will want to also make sure that this is happening in this proposal. So let's set it to 2030 for the year of purchase. So that's the first step here. The second step would be to create another proposal with an additional property purchase goal. And this time we'll set all the same parameters up except for the down payment, term, and interest rate. So you can, of course, always stick with the default current and proposed in RightCapital, but do know that you can always add additional plans as well. So maybe if you are setting up multiple what if scenarios, it might be helpful to, create some dedicated plans for that. So what I just did was make a copy of the existing proposed plan. So that's going to factor in any changes that I've made to the original proposal. So the 100% down vacation home purchase that I modeled will carry over into these plans. Maybe we want to create a scenario dedicated to, that 100% down scenario. And then maybe we want to model an alternate scenario with 20% down. We can name these plans separately, click OK in the lower right to save those, and then we'll be able to set those on the left and right side. So whatever's selected on the right is for comparison. Whatever is selected on the left is the one that we're actually making adjustments to using the action items. So let's click 20% down on the left here, and we're going to change this scenario up a little bit. So once this loads here, we'll scroll back down to our action items. We'll want to make sure that that 100% down property purchase we added is turned off for this scenario. And then we're going to walk through the process again of adding a new vacation home purchase rather, with a 20% down payment instead. So again, we'll click the edit button, add new items. We'll add that goal for the vacation home property purchase. We can set up all of our variables here to match the other vacation home purchase that we entered. So I believe it was $500,000 purchase price. I believe I had the state set to Florida and the year set to 2030. So, hopefully that's a one-for-one match there. That would be ideal. And then, the change we would model here is to the down payment. So we set that to maybe 20% with, let's say, an 8% interest rate, 30-year term. So, of course, those are rough numbers, but you get the idea. Once we click save here, that's going to be added to this specific proposal. So again, something I mentioned before that I didn't do here is it can be helpful to name these items something a little bit more recognizable. So maybe here we want to call this 20% down so that we can actually tell at a glance which one is which. So let's add that new goal name. So now we have a scenario where in one situation, we have a 20% down payment occurring with that 30-year term, and that's happening here on the left. And then we have our plan on the right with a 100% down payment and no mortgage occurring. So again, we see some differences here in terms of ending assets. It looks like in this specific plan, maybe that 20% down payment with the mortgage is actually going to be more beneficial in the long term. We see a slightly higher ending asset value here for this plan. So I did want to walk through the process of setting up that kind of scenario just to highlight the fact that you can always create these dedicated proposals for these kinds of property purchase and property sale scenarios and directly compare them against one another in the retirement section here.